So we've got OPEX today. It's the name of the briefing. It is the focus of everything today. We have all been kind of waiting on these levels. There's been a lot of speculation about how much gamma is going to be uh, left by next week. So as we usually do, we want to start with what happened in the overnight hours. Look for anything that could carry over into today's market, which includes what sectors in Asia did good. Asia's already closed, but what did do good in Asia and what is doing good right now in Europe? Europe is still open. That often is the bleed over. It'll carry over into our own market. Now, like I've been talking about a lot this week, there was an anticipation of a bounce at some point, a rally, a move to the upside, not because we're suddenly bullish, but because after you travel so far in one direction, linear regression, dot plot statistics, mean reversion, we're going to go back the other way, right? So it's what we do. If take this circle right here, if you always have how far a market can move to the upside or to the downside at any given time on any chart, on any time frame. There is a measured move. It's why things like iron condors work so good. Most of the time, a market will not exceed its expected move. And even the times that it does, generally whips back the other way. It can't sustain that. Now we're talking about mean reverting products, the indexes. You try that stuff with something like an equity product, you're very likely to get punched in the face. Imagine trying that with something like GameStop or AMC, right? See the point. You don't do that on those kind of things. So it's Friday. It is a long weekend. We will be closed Monday. There is nothing in the marketplace moving on Monday. We do have a webinar presentation on Monday at 3 o'clock. Options Omega is going to come in. And yes, it's going to be recorded. I just can't believe people continue to ask this question. Every stream, we try to record it, right? Do we occasionally make a mistake and don't get it recorded? Yeah, but that would defeat your question, right? Because it would have been a mistake that we didn't get something recorded. Otherwise, yes, it'll be recorded. So Monday, 3 o'clock. And what 3 o'clock? The Eastern time zone. I can send 3 o'clock Eastern. Why Eastern? Because nobody cares where you live. I don't want to have to go out and poll everybody and tell everybody the time zones that it's going to be in for them. And why would I give it to you for my time zone? You shouldn't care where I live, right? But we all trade the same market. So 3 o'clock Monday afternoon in the stocks and options channel, Options Omega is going to come in and present their product after they are done. Going forward, it won't be just one time, but going forward, I will be doing afternoon sessions where we rebuild my mechanical systems live, of course, because that would kind of defeat the purpose if I'm doing it and then just posting videos. And those, yes, also will be recorded. So good stuff. Due to the weekend, really kind of keep this in mind today, guys. What kind of market could we expect? We can see looking through the overnight that there's been a lot going on in the bond market. Right before I went to bed last night, Japan rocked the market a little bit with their rate decision. That global bond chaos right now is like top of the list for things that can impact the market, right? There's nothing else out there as high up on the list right now as that. So with this in mind, knowing that it's a long weekend, knowing that it's OPEX, it's triple witching OPEX, and the market has kind of took a little bit of a beat down. We have every expectation that today we could just hold the line, right? And it's kind of what you want to approach it as. What's more likely, that we yet again today make another leg lower? Yeah, I mean it's possible, right? We don't want to take it off the table. We never want to say that price can't do something. But we could leg lower, maybe completely retrace all of yesterday and break out of the top of this range above the 38.50. I mean, yeah, that's on the table too, but is it likely, right? You start playing through the ABC scenarios of what could happen, and you get to the point where you're running down fantasy land. What's more likely for the day? Well, it's most likely we're just going to pause and let this market heal a little bit. That's the kind of language you would hear on things like stockcharts.com, right? Stock Charts TV. They talk often about a damaged chart that needs to heal. 8:30, 8:45, 9:15, 10 o'clock, and 1 o'clock. Now, generally speaking, the rig count, I worked on these rigs for 20 years, that very seldom has any influence or impact in the market. But oil right now is a part of the influence that's going on in this market. You want to keep track of this, especially with all eyes in the entire nation looking at the price of the pump. Now, these rigs most of the time are going to be workover rigs, or they're going to be new rigs drilling into an existing known zone, like sticking another straw in the same lake that they've already got 50 other straws in, and that it has nothing to do with the bottleneck at refineries. But it will make people feel better to see how many rigs are coming back up out of the dirt that are being refurbished in the yards of Oklahoma and Texas and getting back online again. So, as a headline feature, the rig count may have a little bit of impact today. Not by much, though. I mean, just you got to kind of have a little perspective. This is the Thinkorswim platform. So those are going to be the time frames. I would add to this time frame that Biden is supposed to be speaking at 8:30 this morning. Keep in mind he's the president, so he's usually late, and it has nothing to do with who the president is. Every president is usually late, right? They've got a lot on their plate besides going out and chit-chatting with reporters and doing these events. So you're very likely going to have to wait on him. And unlike the previous president, most administrations don't try to rock the economic boat, right? They don't deliberately go out and throw fire bombs at the market just to see it explode and move around. So we shouldn't see too much impact. We shouldn't see any sort of inflammatory statements or anything like that. But that doesn't mean that this guy can't put his foot in his mouth and say something that may inadvertently rock the market, anyways. So the way that you approach that, just be prepared. Just recognize that there is uh, somebody of influence speaking at 8:30 who has the potential to influence the market. It lines right up with one of our economic uh, reports, anyways. So you should already have been approaching with caution. There was some massive flooding going on in the Yellowstone, Wyoming, all up in there. Um, one of the last rigs that I worked on was up in that area. I mean, not not the Yellowstone area, but Utah, Wyoming, the Dakotas. Apparently, there was a lot of flooding, wiped out a lot of roads. If they're trying to bring rigs back online, you have to have some really good roads to move them rigs around. All right, so how we approach it. We've got an ADR of 2.8. That would be considered a normal move, right? We're not talking about an extreme move, just a normal move. And like I was talking about, when you're considering how far a market could move, there is an expected move at all times on every market. Just think of it like a circle. And if I could ever be the one that programs anything on like a new broker, it would be a feature that could put on like a little shadow circle around price that you could just adjust it to whatever standard deviation you want for whatever time frame you happen to be on. Obviously, we don't have something like that, but if you want something even remotely close, the Bollinger Band fixes the problem. It's not a circle, it's a band. Default Bollinger Band is 3, or is a 2, excuse me, not a 3, it's a 2. But if you set it to a 3, then you're covering 99.9% of all price action. So price should stay inside that boundary on whatever time frame you're watching. And when it exceeds that, it won't exceed it for very long. It takes too much to keep a market outside of those boundaries. We're talking about a 3 standard deviation move. So if you were to use something like TrendSpider or TrendSpider-esque style indicators, where you could apply a daily Bollinger Band on an intraday chart, you would have a 3 standard deviation high and low of how far the market could or should move on a day-to-day basis, and you would know when you hit the edges of that sucker. Because again, when we travel that far, we're very likely not going to stay outside of those boundaries for very long. That statement and that comment is about indexes and sectors, not companies, not equities. So obviously, if you go and apply that to something like GameStop, you're going to see where it may have exceeded the range for a long period of time. So our expectations for today, what is it that we anticipate for the day? That we maintain the range from yesterday, that we hold the line and we hold the low that we were given from yesterday, and then we go into the weekend without any major train wreck. Now, in the last few days, we've all been waiting for that upside rally. And in a bear market, an upside rally is very often very, very violent and very extreme. We're talking, tickling the lock limits of an upside move. So 7% move to the upside. We haven't had it yet. There's no guarantee that today is going to be the day that we get one. And considering it's offset OPEX with triple witch, I don't expect it to be today. Could we stay positive? I mean, yes, we're already up, near 1%. All the market has to do with us being up 1% for the headlines to be positive going into the weekend, all the market has to do at this point is just maintain right where it is for the rest of the day. That's all it has to do. It doesn't have to do anything else. And they'll report as, oh, it was a positive day in the market. The S&P and the Nasdaq gained blah, blah, blah. And they will be able to carry that narrative all weekend long. They don't need to do anything else. So we want to go ahead and map out our ranges. The ADR that I normally have on here. What happened to my ADR? I deleted it. The ADR to the upside is 37.83. That would still be below the high of yesterday, which is the 38.33, that green line right there. Now, we could make an exaggerated run or an exaggerated move that far. I find it unrealistic. From our current location, it would be another 3.3%. We're basically up one. So we're talking about, 4%, 4.25% move in the S&P in a single day. Yeah, it's doable. So if the dominant thesis is that we maintain inside of yesterday's price action, then yesterday's RTH is going to be the first focus that you would want to deal with. That would be the range that I just marked. That's yesterday's RTH high and RTH low from 37.11, which is a cog line, down to 36.40. That would be zone one. If we manage to break through that and continue to move to the upside, then we would focus on zone two, which would be from our own Globex high to the high of yesterday. So basically from the 37.11 cog line all the way up to 38.33. That would be zone two. In the middle of that zone is the ADR. So we've got the upside targets firmly planted. The downside, if we were to take this on the road and go the other way, we would first need to get back down below the RTH open of yesterday, the Globex open, the Globex low, the low of yesterday. Then we start dealing with the ADR on the day. Half an ADR would be 36.28, and a full ADR move to the downside would be 35.77. So we've got our downside targets lined up as well. Keep this in mind. If we start breaking back down to the downside, things could get real violent real fast. And that's what we want to be prepared for. Any move at this point, taking the S&P back to 0% on the day, would be significant. That would be one of the first things that should get your attention and make you start to think when what should happen doesn't. The next step in the same vein would be if we happen to break down below yesterday. I mean, we're talking about that's where it's really likely to pick up. If there's no bids, and there very likely wouldn't be any if we start breaking below that level, you can't find anybody to buy, right? There's always this old phrase that if you're trying to buy, you can always find a seller. But when you're trying to sell, you can't always find a buyer, right? Especially when everybody's selling and nobody's buying. I've heard the phrase the bidless beast. I didn't coin it. I'm not trying to steal it, but it does kind of set the stage, right? It kind of puts things into perspective. Consider the narrative of what you're looking at. We're all looking for a consistent theme, a consistent narrative. When you have one time framing, or you have nothing but one particular candle color over and over and over, and there is hardly any profit taking at all, and absolutely no firm of any kind going the other direction. Everybody out there is all doing exactly the same thing, trying to find someone to buy what they're selling. You can see the markets move very, very fast in that kind of situation. That's where things start to really get out of control. Because on any normal day, when you have a two-sided market, you have some institutions going long, some institutions going short. A lot of times the algos are just trading things back and forth amongst themselves, and we have to try to figure out who to follow at any particular time. We can't ride the wave when two beasts are just creating massive waves all over the market. But when it's a clear and consistent message market, one time framing, nothing going in the other direction, nobody trying to go long in a market like this. There was only profit taking and minor amounts of that. That's what we're going to be focused on if we start to break down to the downside today. Because the dominant thesis right now is that we will hold this low and go into the close for the weekend without setting new lows on the day. That's the dominant thesis. So when what should happen doesn't, WWSD or whatever the little acronym is, we start breaking down, it's very likely to get nasty. Speaking of nasty, we've had some very exaggerated moves in that move in the dollar yesterday. That was just, gotta say, that was freaking me out. Didn't really know what to do with it. The same thing with the gold move yesterday. We're talking some exaggerated moves that just, there was nothing to do with it, right? There was absolutely nothing to make sense out of any of this because we weren't seeing any direct repercussion in any way. It wasn't an inverted market against the S&P or the Nasdaq. It wasn't a correlated market with the S&P and the Nasdaq. It was just these massive sweeping voluminous amounts of capital being moved, and it was causing absolutely no impact in the rest of the market. So sometimes there's just moves and we don't know what to do with it. But most of the time, and I guess it did provide the one thing that I did with it. I stayed the heck out of the way, right? I waited most of the day to finally get my trade on because of this thing. So we are getting a little bit of a bid in Bitcoin. At least it is up off of those lows. We did hold above 20, which is a little bit of a shock. At this point today, that's the name of the game. We just need to get into the weekend, right? And of course, Bitcoin is open on the weekends, not necessarily the futures, but Bitcoin is not something that just trades, during the week. But we want to get into the weekend, maintaining that 20 or better. For everything else, we just needed to calm down and get into the weekend without breaking anything. That goes from the oil market to the bond market to gold to the dollar and to Bitcoin. Across the board, we just need everything to hold the line. So if I start seeing any exaggerated or any extreme moves, be ready to start taking positions off, tightening up your stops, or prepare for a big move, right? As I wrote in the lunchtime review yesterday, look for, say, the VIX or the dollar to be at a support level while the S&P and the Nasdaq are at a resistance level, or vice versa. VIX at resistance, S&P at support. Look for one of those to break ranks, break support, break resistance, and for the other one to follow suit in the other direction. Those can be your confirming signals. All right, for the Nasdaq. Well, let's hold on a second. Let's validate these pivot points. So we're on a 10-day, 30-minute chart. This is a very wide volume profile at this point. We are encompassing almost the entire screen. We have a significant level of volume over our head at 3770. That's the value area low. The value area high is at 4190. I mean, that might as well be on another planet. Same thing with the point of control, which at 4111 or 4113 to cog line, again, it may as well be on another planet. We still have a really wide gap that needs to be filled too, right around that 3911 area. What we want to watch for are these very shallow areas. Price is very likely to move through these zones relatively easy. And that when those shallow areas end in these high volume nodes, those become areas of volume resistance. So there's volume resistance at 3,900, at 3,770, and there is a little bit of volume support underneath this at 3,670. Now, the one in blue may look just like another volume profile, but it's not a volume profile. It's a TPO, time price opportunity. These are not custom indicators, by the way. They're just typical regular thinkorswim indicators. Volume profile, TPO profile. Think of TPO as how much time did we spend at a particular location? And what it's recording is how many transactions transpired there, not how many contracts, right? If there was one trade with 1,000 contracts, it would still just show up as one. A volume profile, on the other hand, is not counting the transactions, it's counting the thing that was in the transaction, shares, contracts, whatever we happen to be looking at. So when we put the two together, we can look at how much volume by price and how much volume by time. So that when we hit, say, this low down here, where we did not spend very much time at all, we can see, was there a significant level of volume at that level? Because if we didn't spend very much time there and yet we still garnered a lot of volume there, then there was a large pool of resting orders, and we still have to ask the question, did we get them all? Is that done? Did we, accumulate all of that is down there, or is there more? Volume support on a 10-day chart has to be taken with a little bit of grain of salt, right? We're not going to lean on these things like a handrail. We wouldn't put that kind of trust or faith into something like this. And even though this is a 10-day chart, we weren't down here 10 days ago. So this volume is relatively new, right? We got down there recently, not last week or 2 weeks ago. So yeah, it's a 10-day volume profile, but that's new volume, right? So when we're outside the box, and this is the box, we have to ask the question, are we continuing to move farther away from the box, or are we moving back towards the box? Generally speaking, when we're outside the box, we expect to go back towards the box. Think of inertia, or when what should happen, right? If you take a balloon and hold it underwater and let it go, it will instinctively gravitate towards the surface. That's what it does, right? It's its natural default state. Same thing with the market. Dow logic says the market just goes up. That's what it does. It just goes up. And when it doesn't, it's because, just like you holding a balloon down underwater, when the market doesn't just go up, it's because there's external forces holding it down. When those external forces lessen, the market buoys. It's its natural default position. So when we are outside the box, we want to see the price moving back towards the box. That would be its default natural state. If we see it continuing to move farther away from the box, then we would get into the logic of when what should happen doesn't. We would also be using this to identify where the point of control is and the value area high and low, but as I mentioned, they are very far away. We wouldn't be really too concerned with them at this point. This is a 5-day, 5-minute chart. We call it mapping out the 5x5. If we were to mark out all of our trend lines, it would be the high, low, close, open of the previous days, in the expectation that if we happen to come back to those pivot points, there's very likely to be a reaction in the market. Hey, Goofy, that's hot coffee. Stop it. Lay down. So we want to carry forward any point of controls that have not yet been hit. And well, I was going to say we may have one from yesterday, but nope, it was already hit. So we have no untouched points of control to carry forward. You could carry forward the value area low and high. The value area low from yesterday has not yet been hit, so you could carry it forward. I just don't carry a lot of veracity with that. I don't give it a lot of validity. If you were to study volume profile logic, though, they do talk about carrying those forward. I'm not against it. I don't do it. I've got enough pivot points, and mine usually line up very close to those anyways. There is an untouched point of control looking back from last Friday, but it's at 39.11-ish, and I see, a snowball's chance in hell we're going to go up there and tickle that thing today. We are still underneath that angled trend line. The points that we are using for contact are back here. We narrowly missed that trend line right there. We broke through it yesterday. We're now trying to get back through it. We are still underneath it. The new expected move is already drawn. This is not yet locked, right? Right now, it's going to continue to move with the market. That center line or that gray line is the right now current price of the market. So as the market moves up and down, so will this entire box move up and down until we get to 4 o'clock. We go into the close, it will lock in place, and then that will be the new weekly expected move. One thing that I always like to do when I get the new expected move is compare it to last week's expected move. It's just a visual. You can just take it and set it on top of it. Now recognize what I just did there. All I did, nice and simple, I drew a box encompassing all of the new week, and I didn't, zoom in and get it anally perfect. Just nice little sloppy box. And I stacked it on top of the old box. Anything stand out? Yeah, it's bigger, right? It exceeds the range of this week. So they're saying that next week has more implied volatility or more volatility pricing into it than this week. But remember, next week's a short week. So it may look like it was just a little bit bigger, but parse that out a little bit. It's 1 day less, and yet it's bigger. So it's not a little bit bigger, it's a lot bigger. This week's expected move was around $100, if I remember right. And they're pricing in for the next week $150, even though it's only going to be a 4-day week. So that's a significant change. All right, for the Nasdaq. Same thing, we just need to hold the line. We just need to maintain the low without getting any new low for the day. And that will give the news people the narrative that they're looking for. They can go out and say, "Oh, it was a great day. The market, reclaimed some lows." They can spin it however they want to spin it, and they'll give all kinds of reasons for why we are up today. It's all everybody's warm and fuzzy and happy. They feel good. Blah 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 blah. But we know already that the market had made a significant move in one direction, and it needed to come back the other way. The narrative aside, whatever they want to try to apply to it, we were all expecting some sort of pullback at some point soon because it was due for one. So the dominant thesis is that we will go into the close today inside of yesterday's range and hopefully above that white line right there, which happens to be where we opened in the Globex. Should we break below the Globex open, we're going to expect to see some violence start to creep into the market. And if we should break the low of yesterday, then something like that bidless beast or some very extreme reactions in the market would be the expectation. Bear market rallies are a phenomenal thing to behold. So as we come into the open, one of the things that I like to focus on when we're gapped up is where was the last pivot point, especially where was the last Globex high or where is the Globex high? Because if we come into the open and we're underneath that, say we're not pressing against the Globex high as we come into the open, but we've faded off of it a little bit, that becomes the very first pivot point that we focus on. Now, remember, when we're gapped up and we come into the open, we expect red candles, not because we're bearish, not because sentiment, just because we are gapped up, we expect to see the market try to close that gap. The gap that it would be trying to close is from where we open down to that white line. So if we go into the open and we instead continue to move farther away from that white line first, then there's this really good play where we expect to see it reject off of that Globex high and then dump. It doesn't have to do that, but that's the play. I love that play when it works. It's phenomenal. It happens between 9:30 and 10 o'clock. And the tricky part is, take a morning like today, we have no reason to be up this much other than linear regression. So if we were to reject and begin making that move to the downside, we wouldn't be trying to catch a falling knife at that white line down there. We wouldn't think we were going to bounce and continue to go up. We would instead be focused on continuation to the downside. But still, there's plenty of room right there. Plenty of room right there. So trading the open has all kinds of different trade strategies associated with it. It's worth going back and studying previous opens and where we were at by how much. Um, if this is going to be, quote, a trend day, which the way that I define them today could not be one until we break outside of yesterday's range. But suppose we ignored the yesterday range point and we just talk about breaking out of our own Globex. If today is going to be a trend day, all we need to do is break out of our own Globex high. If we were to break out of that, we could easily see a trend day up to the ADR 11,615. Those that have gone through my work on the 4 trend days, you know what the chart would look like, the kind of move that we're expecting, but you would also already grasp that if we're inside of yesterday's price, it cannot be classified as one of our trend days, right? When you think about it from the logic of a daily chart, if you have a day that's sitting inside of yesterday's day, you didn't trend, you didn't go anywhere, right? It doesn't matter if in that intraday time frame you had higher highs and higher lows or lower highs and lower lows, a consistent, persistent market message and a trend within that day. It doesn't matter. It wouldn't be one of our 4 trend days because it's still sitting inside the previous day. Now, once we break out of one, maybe this one, right? Although doubtful. But this one, I bet if we were to go back and look, we would find that to be one of those trend days that we're talking about. Maybe one of those, right? Where we broke out. We were on an inside day breakout. Now, the thing with Powell today, it's supposed to be, quote, quote, just some kind of conference thing, right? He's not supposed to come out and talk policy or anything like that. But one, I haven't checked to see if it's any kind of pre-recorded message. That's always something that you want to look for because it's sneaky. they will have these pre-recorded messages, and we will all think that there's something to be said or some angst that could hit the market, and then we find out later, it was just recorded. He wasn't even live anywhere. So, dig a little deeper into it and see what it is. And normally at a conference, unless he screws up and accidentally puts his foot in his mouth, he shouldn't say anything that should rock the market. They're not activating the plunge protection team because they're trying to get this market to go down, not up. So I wouldn't expect him to come out and um, buoy the market in any way. I also wouldn't expect him to come out and deliberately tank this market, right? We would call it Operation Don't Rock the Boat. So it's a neat little puppet trick. He comes out and runs his mouth and he says a bunch of things that doesn't mean anything. That would be his entire goal, to talk without moving the market at all, and to not offer any policy statements whatsoever. He already gave us that wishy-washy two-sided junk from the other day where he said extremes are not going to become the norm, while at the same time he said, oh, but by the way, we could very likely hit you with another 75 points in July. Well, which is it? Either the 75 points isn't going to become the norm, or we're already going to just use 75 for next time. Yeah, you can't have it both ways, but he got his cake and ate it too, which is why the market had such an odd move Wednesday, because the market said, I don't know what the hell he meant. And price showed us that we didn't know what the hell he meant. The old Dow Logic 101. Everything we need to know is already priced in. All right, so let's get her done. Let's wrap it up for this morning and go get some money. We are bid up. So the sectors are bid up 3 out of 4 or 8 out of 10 or 19 out of 20. Take your ratio. Whatever the S&P is doing, that's what most of the market's going to do. So when the S&P is range bound, most of the market is going to be range bound. We are inside day, and any move to the upside would be inside day, right? Because yesterday was just such a large range that it would be almost impossible to see an inside day breakout to the upside without first having already made 3%, right? It would take a significant amount. And since there's only 12 hours, not even 12 hours left in the day, we're kind of running out of time, right? TikTok. If we were to have an inside day breakout to the upside, getting to that point would not be subtle. UVol, DVol, tick, trend, market breadth, AD, everything across the board would be lit up like a Christmas tree. You would see this market swell with the volume and the flow and the tape, the pace. It would be an absolute ripper. It would not be subtle, sneaky. It wouldn't get by you unnoticed. So to even consider an upside breakout, an inside day breakout to the upside, have no fear that you're going to miss it, because just getting to the top would take an insane amount of flow. All right, so we are looking at the heat map. S&P 500. Set it to pre-market change percent. Just a second. Set it to pre-market change percent. Adjust it. We don't want 500 names. We actually want about 100 names. I use the market cap to make that adjustment. So we come in, notice it's got 503 matches, which is, it's the S&P 500, 500 names. We want to knock it down to near 100. 101 is close enough. This leaves us with some gray areas, right? So we just want to adjust this one more time, give it a color scheme adjustment. And now we can see where the monsters of tech are. They are the bigger boxes. These box shapes are a part of their market cap. The bigger the market cap, the bigger the box. And as you can see, we are in a risk-on sentiment. We already knew that, right? We've been talking about the fact that the S&P is already up near 1% this morning, but it's what sectors, what names, what industry, sub-industry. And when we're talking S&P versus Nasdaq, one of the defining differences is the financials that are in the S&P when there are no financials in the Nasdaq 100. So it's one of the first places I always gravitate to when I'm looking at something like this is where are the financials and how are they doing? And which financials? Credit cards, lending institutions, regional banks, trading firms, um, insurance companies can be tucked into that list. And then how about the energy market, right? So looking across the board, healthcare seems to have a little bit of angst this morning. It's a little weak. Couple of chip names like Texas Instruments, uh, the War Machine, Raytheon off of its game a little bit. Travel, right? Transportation, I should say, not travel. So it's not looking too bad, right? And nothing's extreme at this point, which is good to see. So Microsoft up near 1%, Google 1%, Apple 1%, Amazon 1%. Yay. But at least it's not 3, 4, 5%, right? It's really hard to want to participate in a market when it's already made that kind of move. Keep in mind, if we do start to roll over and head to the downside, the names that have traveled the most to the upside this morning are going to be the names that we want to hammer down the hardest to run them back to zero and beyond. So that's the S&P 500. We want to take a look at the Nasdaq 100, and keep in mind when you're looking at something like this, this isn't where we wouldn't look at this and think, well, I'm going to go trade it because I saw it here, right? This is just a starting point. We're looking for anything that stands out that gets our attention. You're able to see 100 names at a glance, right? So you're not trying to do any deep dive technical analysis. You're just taking a quick glance to see if anything in particular stands out. And most of the time you won't, right? But that's the point. Most of the time you won't. So you come in, you take a look around, nothing really stands out, you move on from it. If you do this in a watch list, it can be a little more tricky, right? I mean, there's plenty of us who learn to trade with the watch lists, but you can look at the 100 names in the NASDAQ watch list, or you can look at those 100 names right there. I think it's a little more intuitive to see it in the heat map. How many names in the NASDAQ 100 are up at least a half of a percent? 47. With just three more names, 50% of the NASDAQ would be up a half of a percent this morning. That's a pretty bullish number. It's not extreme. It's not the best that I've seen, but it's a really good way to come into the open. We're feeling pretty bullish out there. It's a risk on marketplace this morning. I like to be able to quantify that. If we really expected it to be one of those rip your face off rallies to the upside, one of those bear market rippers of 6 to 7%, we would expect to see a lot more names here. 65 to 70% of the NASDAQ being up at least a half of a percent. But 47 is a good start. When we get closer to the open, I would revisit that number and see if we're any better off than we are right now. How about 1%? How many names are up at least 1% in the NASDAQ this morning? 33. So 33% of the NASDAQ is up at least 1%. That's a pretty good number. Usually anything better than 30 kind of gets my attention. This platform allows us to see how much of a gap we're looking at. So things like JD, Baidu, a couple of those China names, they are gapped significantly this morning, right? Pre-market change percent, we're talking, nearly 9% in JD. Fastenal with a 4%, and Baidu and Lucid 3%. So we had some pretty good gappers out there, right? But again, it's a glance. This is where we start to try to think of the 600 names that have weekly options. That's a lot of names. We got to funnel that list down to 3 or 4 names as we come into the open. So we want to think about it just like that funnel. Each layer taking off more and more names until you're left with just those 2 or 3. And then approaching it from the point of view, are you looking to be a contrarian this morning, trying to short the names that are up the most? Or are you looking to go with the flow this morning and find names that have not yet made 8% moves and take a run to the upside? There's no right or wrong to that answer. It's more about what are you trying to do? So that's the Nasdaq. We'll flip around and ask the same questions for the S&P. How many names in the S&P are up at least 0.5%? I'm just going to steal one and say 50. 50% of the S&P 100 is up at least 0.5% this morning. That's a good number. That's a nice risk on number, especially when we're not seeing extreme gaps, right? There is a little bit of a gap, right? Some names that are a little bit like financials, and I'm glad to see it's financials. Uh, Bank of New York Mellon, Capital One, Bank of America, PayPal, Morgan Stanley, Goldman Sachs, Bancor, American Express, finance, finance, finance. So when we're looking at the 3 sectors that can carry this market, we got to focus on the 3 risk on sectors: finance, technology, consumer discretionary. When we think of the monsters of tech, that's the 3 categories that they fit into: Tesla, Apple, Microsoft, Amazon, Google. The monsters of tech can completely carry the rest of the market. So you could have 90 names down in the S&P, but as long as you got the monsters of tech going up, the market will go up. So that's the S&P at a half. How many names are up 1% in the S&P 100? 32. All right, it's above 30. It's kind of my benchmark. It needs to be up. I want to see at least 30 names in there to carry that risk on sentiment. We have the potential, or not have the potential. We are primed right now for a red to green. Now, red to green is a daily chart concept. Yesterday was a red day. Dun, 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 dun. Thanks, Captain Obvious. I think we figured that out. But what you want to see for a red to green setup is a pre-market rally. You want to see a market rallying up from where it closed yesterday and preferably getting above where it opened yesterday. That's one of my criteria, just because as we come into the open, if we start to fade back a little bit, it'll find yesterday's open for support and then that bounce and run. Now, it doesn't have to open above yesterday's open, but I'd like to do that, especially if I've got 50 names that are all red to green this morning, right? Because again, we got to narrow that list down. I want the best of the red to greens. So another little trick to the play is, if you're going to focus on a red to green, try to find one that matches its overall direction anyways, right? And for an example, Apple is trending to the downside. It has consistent, persistent moves lower. And we are at the edge of that swing high and swing low, right? Swing high, swing low. We had a muted swing high where we set a high back here and we set our low and we failed. to even get remotely close to the next swing, but we've now got our low. We have every expectation of completing the swing again. So a red to green in Apple, for an example, matches the swing, but it doesn't match the trend. Considering the liquidity of Apple, it'd probably be pretty high on my list. But I would continue to look and see if there was anything better. Like Microsoft, well, it's trending just like Apple. About XOM. XOM has been consistent and persistent in its upside move. We're up on the year. We've had a significant pullback, which is what we want to see when we're trying to trade a trend to the upside. So the trend is right. The red to green is right. We've even got enough of a gap between yesterday's highest price and the previous day's close price so that if we did break out today, there's enough room for us to make some money. And energy overall has been doing good. So it fits the trend and the red to green, and there's enough of a gap there to give us a little bit of love. So this would be one of the names that would be fairly high on my list. But if you can find higher beta names, that's even better, right? Say your list is done and you've got 12 names and you've still got to get the list smaller because 12 names are too much. Come in and look at the fast beta. Rank them in their order of beta. Anything above 1 is good. Anything below 1, not so good, right? If it's above 1, it would have the characteristics of the S&P. If it's below 1, it will be more inverse of the S&P. So maybe XOM isn't such a good idea when it has a beta of less than 1. If we were to get a rally in the S&P or the Nasdaq today, we're very likely not going to get a rally here. Still, if we remove the red to green and just think about a long trade, a new swing in a long trade, swinging energy to the upside would be a pretty good idea. And we are near the lows of the support. So that may be something we talk about today as it's my day to stream. We may build out a new position in ExxonMobil. All right, Google, consistent, persistent move to the downside. And I think that's going to be, like most of the answers that we would find today. But for our red to green setup, we just want to see this opening at least as high as yesterday's open. I do have videos on the red to green setup. They're in the next level library on the bullish bears. If you can tie a red to green with something like an IX10 or even just an inside day, it's better. You want to go through the list, go through your names, find a red to green that meets all of your criteria, say a 2.5 or a 3 fast beta, good liquidity in the options, preferably in an upward trending market that may have had a pullback, right? Because that's how you'd get your red candle for the red to green. Pre-market rally above the previous day's open at least, if not completely outside of yesterday's range. That's even better. And then you would have a pretty tight watch list coming into the open. That's what I got for you guys. I will see you all at the live stream starting around 9:15ish like